Hello and welcome everybody to our next Road to COP26 Insight session. This morning is being hosted by the Advanced Propulsion Centre and the Knowledge Transfer Network, and the broad theme, as you know, is investing in net zero emissions future. I'd like to start the session with some housekeeping. Please be aware that your microphones and cameras have been disabled, but we do want to hear from you. So for questions, if you can use the Q&A box at the bottom of your screen, you can submit your questions there and we'll go through these at the end of the presentations. There's also a chat box and you can use that to make any comments as we go along. And you can also ask for technical assistance there because that will be monitored as well as we're going through. We are going to be recording this, and at the end of this session, it will all be curated and you'll be notified by email and social media channels when it's available. That'll be on the APC website. And we would ask you to fill in a short survey for feedback on behalf of the APC at the end of the programme. So moving on to the session, what can you expect today? Well, we've got a fantastic set of panelists today. And what they've all been asked to do is to talk about and to bring their insights into how we need to work together to hit the targets and ambitions of the UK sort of net zero and transition to electrification. So we have COP26 coming forward, but what are we going to do afterwards? How does the public and the private finance sector work together to support technology development and the transition to that net zero future? We will be hearing from Julian Hetherington from the APC at the director, Alexander Leigh, who'll be talking perspectives from regional development banks and that regional support as well as the national support. Rod Beer will be introducing early stage investment and the role of angel investments. Stephen Price will be talking about that early stage VC funding, and Lucy will talk about growth investment funding. So we're going to have a really great session and lots of different perspectives and viewpoints. But firstly, for those of you who don't know the Knowledge Transfer Network, I am from the Knowledge Transfer Network. We're delivering this, as we said, in partnership with APC. So the KTN is funded by Innovate UK. And we deliver a number of projects and programs on behalf of Innovate UK, as well as other sort of funding partners, around supporting innovation collaborations. It really is around driving innovation, accelerating innovation through putting people together through funding, finance, grant funding in particular, as well as bringing together those collaborative relationships and partnerships. We also have a small team that works around investment, and we work with our sector leads around bringing together investors in front of typically cohorts of companies under specific programs and themes. So it's really about connections into the investment community, support around our investment readiness programs, where we'll be preparing you for investment and sort of strategic funding and finance, and helping you with your fundraising strategy. Then there's also a few programs around knowledge sharing, which is around webinars, events, roundtables and activities like that. So we're a small team. This very much complements the Innovate UK programme of support. So you also have the catapults and of course your regional business support and one-to-one support from the Innovate UK Edge. As I said, we're a small team. This is myself. I've been with the KTN nearly 6 years, and Jordan, my colleague who joined earlier. Some of the programs that might be of interest for you that are running at the moment include the Battery Faraday Battery Challenge. There'll be another Transforming Food Production Series A investment program. There's Chemistry and Industrial Biotechnology, Manufacturing Made Smarter, a Materials Research Exchange, and our innovation networks. We have quite a diverse network of national, regional, and global investors that we work with. And so do engage with us if you have any sort of technology requirements, as well as sort of funding and finance requirements. At this point, I'm going to hand over to Julian Hetherington. So Julian is as I said, is the Director of Automotive Transformation at the APC. Before joining APC, he had over 31 years in the automotive industry, initially at Ford, and then over 20 years at Jaguar Land Rover. Most recently, he's been at the Globalization Programs Director, where he's responsible for overseas industrialization programs. So Julian, over to you.
Thanks very much, Emma. I'd just like to talk a little bit this morning about the importance of the funding journey that organisations, research and development organisations transitioning into industrialisation need to follow, and how the various elements of the ecosystem can help support that journey and that transition. And what we've tried to put together here is a little bit about what sits there in terms of cross-sector support. Obviously, at the front end of the process, you've got organisations such as UKBAA with the EPSRC rather, then you go into Innovate UK with other programmes such as IDP. And when we're starting to look at the APC's role, we sit very much when we get to the post-concept readiness stage and how we support that journey through into industrialisation through our core collaborative R&D programmes, and most recently last year with the Automotive Transformation Fund being introduced to help de-risk those large-scale capital investments associated with scale-up to large manufacturing scale. And of course, cross-sector, there are many other areas that can support, such as driving the electric revolution and the Faraday Battery Challenge, as Emma has already mentioned. So just a little bit about the APC. We're trying to build for the long term. Our ambition is definitely around net zero, having the last 7 or 8 years focusing on improving the CO2 performance at tailpipe, and we're now moving very much towards supporting that life cycle impact and the net zero position, with some significant results delivered to date in terms of CO2 savings through projects that have been implemented over that period. So how can we help typically? Well, R&D competitions can help, but really what we're trying to do is address one of these real challenges where you've got overlapping priorities and drivers and risk drivers. The risk of having sufficient demand for your output, the risk of being able to deliver on time or not, and the risk of being able to fund your program or project or not. And there are many, many different factors that can influence one of these 3 circles, and there are many others that sit beside them as well. But these are the 3 key ones. And really what we're trying to address is how do we unlock funding opportunities to ensure that this journey can be unimpeded. From an investor perspective, how should we view risk? You know, there's a risk-reward balance. We've got this dynamic between government investment and private sector investment and the nature of that private sector investment. And then you've got other mechanisms such as commercial borrowing. But that's much more difficult when you're transitioning and you're looking to scale up very quickly, particularly for startups or new technology sectors. And we have to think about whether there is a ranking of risk or whether there is shared risk between different investors. So simply put, we look at core competitions for APC. We've just closed APC 19, the latest round. It's an example. We run these several times a year. Significant tranches of funding available for collaborative R&D projects to help transition that R&D from concept readiness through to manufacturing readiness. And that can be up to 50% funding on a collaborative basis, potentially more for smaller organisations. And this helps us build that capability. We've also got the capital fund when you get towards the end of that journey and you're ready to scale up. And this is the Automotive Transformation Fund. Think of it as sector specific. It's also thematic. It's around the theme of electrification, and that supports batteries, motors, power electronics, fuel cells crucially as well as part of the mix, and especially the upstream supply chain, recognising that to have a competitive entitlement in the UK, you must also have good access to a competitive upstream raw materials supply chain. So that's how we can help. When we look at the other end of the scale with TDAP, with our Technology Development Accelerator Programme, we've got Wave 6 running at the moment, and this gives really smaller businesses the opportunity to get not just funding, but also wraparound support to help in that journey. So if you want to talk to us, do please get in touch and we can give you a lot more information about those mechanisms. But fundamentally, it's about balancing the risks that are very much seen as we are in this technology space.
So thank you very much, Julian. That was a really good overview of all the different sort of funding opportunities that are out there at the APC and some of the earlier stage government funding and grants. Next up, I'd like to invite Alex from the Development Bank of Wales. So Alex is a senior investment executive at the DBW. He joined the Regional Development Bank in 2018 and has a particular focus on early stage technology-led businesses, particularly those obviously that are looking to raise equity finance and are based in West Wales or are willing to move to Wales, where Wales has a great ecosystem around the automotive supply chain and a really great history. So over to you, Alex.
Thank you very much, Emma. Good being here. And I think we look for companies to move to West Wales ideally, but I think Cardiff is far enough for a lot of people. I'd just like to share, I'm going to share a slide about why we exist and why this is such a unique opportunity. And it's interesting, you have the Development Bank of Wales, but people ask, where's the Development Bank of England? And as far as I know, it doesn't exist. So it is a very unique offering. And it's why, I actually don't live in Wales, but I commute to work, or at least I used to, because of the opportunity. And it's just a really great ecosystem that has been created. And you look at the pace of change in Wales, it's really akin to what's happened in Tel Aviv in Israel. But first up, just want to explain why we exist. So what we're looking at there is the fact that there's this big public-private funding gap. And I think if you look at the London Series A market, or just the later stage VCs, and we're going to hear from Lucy later, what you'll see is that there's this valley of death. So companies start out doing, in the research phase, and then there's this period of commercialization, and then they get all their ducks in order and they go into growth phase. And in between that, there's this valley of death. And why is it called that? Well, because most startups die. Either they don't get funded and actually make it into the valley, and often they don't actually make it out of the valley because it's extremely difficult. And I saw a stat the other day saying that it's roughly 80% of companies fail to raise a follow-on round, and also they're not exiting. So even though they get their seed investment round, they actually don't, they don't manage to raise follow-on finance. And that's one of the reasons why DBW exists, not only as a source of initial capital, but as the ability to follow on. And so during this time, what companies need to try and do is fully form their team, get a well-rounded board, make sure that their product is technically robust, and importantly, get their monthly recurring revenue if that's your type of business. And I know there's various different types of business models, but get it up to that magical 1 million ARR, or be on a very steep growth trajectory that it attracts later stage VCs. And again, why does DBW exist? Because the private sector doesn't have the propensity for risk and can't tolerate the risk that's required to invest at this early stage. The other thing is that startups take between 7 and 10 years to exit. And again, private sector doesn't want to wait that amount of time. They can maybe wait 5 times to procure an exit. So what you really need is patient capital. And then most importantly, getting out of this valley is not just about having funding, because if you have the funding and you don't know how to spend it properly, or you're unsure what resources to bring on or how to build your company, it's not going to work. So what you need at this early phase is you need more than money. You need someone who's going to actively support you on this growth journey. So DBW fact check. So first up, I'll start off there. Development Bank of Wales, of course, headquartered in Wrexham, but big presence in Cardiff. And just to give you an idea of the scale of DBW, so point one, 2.5 billion AUM, assets under management. And currently, point number 3, we've got £1 billion of dry powder that we are ready to deploy into the Welsh economy, and that's primarily through equity financing. So if you've got a startup, a tech startup, there is loads of capital available, and obviously, you have to meet all the relevant criteria and make sure that it's a strong value proposition. But that's an incredible opportunity. And then in terms of more than money, point number 6 there, 2,500 portfolios. Now, most of them are debt companies or the companies that we've provided debt to, but there's at least 150 equity-backed businesses within Development Bank of Wales. And if you just think about the learnings that are generated from all of those investments, all of those companies, and that cross-pollination of ideas and skills and knowledge, again, that's a big opportunity. And then point 8, we do 30 to 40 tech equity transactions per year. So it's a real volume house. And again, you're looking to support as many companies as possible. Now, TVI, Technology Venture Investments, top 3 UK institutional tech investor by volume. So really, for the size of Wales, it really is punching above its weight. We have a very big global network of co-investors. We've got, specialism right from blockchain, cyber, materials, medtech, and of course, general software companies. We can invest, importantly, if you look at point number 6, right from that startup pre-seed stage, right the way through to Series B and beyond, and help you on that journey. So it's not just a little bit of seed money with no ability to follow on. And check sizes, you'll see 0.7 from 250k right the way up to 3 million per one deal, and up to 10 million invested into any one company. So as I say, the money's there, the support's there, and the success stories are really there. In terms of point 8, we're starting to see those IPOs and those big success stories. And as I said, you're looking for more than money at these early phases. So you've got the funding, of course, but importantly, you've got the scale-up support, introductions to CFOs, CTOs, board-level recruitment, preferential rates, lots of due diligence, and of course, we've got a very well-rounded team, which I'll come on to shortly, and importantly, a supportive ecosystem. And I think that's one of the things that really stuck out for me, coming from not being born in the UK, but operating in England and coming over to Wales. I think the Welsh people are highly supportive, and that's exactly what you need in terms of making sure that your startup succeeds. Now, I'll briefly just flick onto the team. And again, doing 30 to 40 transactions per year, you need a lot of team members. And there you'll see, we have a wide range of team members coming from different backgrounds. We've got at least 4 PhDs in the team. We've got cybersecurity experts. We've got ex-entrepreneurs. We've got corporate finance professionals. So there's a really rich skill set. And we all share ideas and really help startups succeed. And that's our mission. So I'd love to take any questions later, but thank you again for listening, and I'll hand over to the next speaker.
Thanks. That's really a really good overview. And I think the other message from this is that actually, if you're looking to collaborate with the supply chain, engaging with companies in Wales is a really good option, because they can be well capitalized. They've got access to really good capital, and there's also growth and infrastructure support, which is all delivered through the Development Bank of Wales. So thank you very much for that really great overview. So next up, I'm going to invite Roderick Beer to present to us. So Roderick is the Managing Director of the UK Business Angels Association. He's been in that early stage angel investment network and communities for over 15 years. He's worked with hundreds of startups, having started first of all with Beer and Partners, which was one of the largest, the first and largest angel group in the UK, I believe. And he's helped to grow corporate finance as their COO. He's been with the UKBAA for a number of years now. He's a very close supporter and collaborator of the work that the KTN, Innovate UK Edge, the catapults deliver. and have the angel community network that UKBAA support is vast. I think you've got over 650 members now, don't you?
Yeah, that's right.
I'll hand over to you to tell us about angel investment.
Thank you, Emma. So yeah, we're the trade body for angel and early stage investing. So we represent those that deploy capital at early stages across the UK. So it's not just the angels, the angel groups, it's also the VC community. I think we have about 50 members who are either EIS funds, SEIS funds, or traditional GPLP funds as well. I will take the mantle of the angel for the purposes of this chat. Just give you, I think I wanted to give you all a bit of an overview about angel investing, where it sits in the UK, and just a little bit about some of the challenges that we're facing, particularly in the automotive sector as well, and around that, and some of the changes that we're seeing, which I think are really exciting changes too. So briefly, angel investing is actually pretty big in the UK. In fact, it's really well advanced. It's one of the most advanced, in fact, in the world. London and the Southeast, and in fact, the UK as a whole is, I think, the third best place to start a business on the planet, which is pretty phenomenal. And it's driven not by small part because of the tax break that we implemented about 27 years ago, called the Enterprise Investment Scheme. Under the Enterprise Investment Scheme, it significantly reduces the exposure of investors' risks in investing directly into early stage businesses. And fast forward 27 years today, about 2.2 billion pounds is invested every single year by about 36,000 individual investors into amazing businesses, whether it's directly into early stage companies or going in through more fund-based structures as well. So it's a significant market and industry. We work very closely with a British business bank, and we figured out, we reckon it's hard to define, but we reckon about £1 billion, north of £1 billion, is invested every year by individual angels directly into early stage businesses. In fact, angel investing at early stages, that seed, kind of pre-seed stage, we saw that Valley of Death stage that Alex showed, probably invest 2, maybe 3 times more than venture capital funds. In fact, it's a significant industry and quite a big market. But as I kind of alluded to, it's done by 36,000 individuals all around the UK. So it can be quite fragmented. It can be very much kind of under the radar and quite hard to pin down at times. So hence why we exist, to make that a little bit easier. Angel investors, fundamentally, I think, and I am biased, but there you go, are a really important part of that ecosystem, because they are one of the only viable sources of capital and funding at that early stage, and actually also unlock quite a bit of additional funding. Grant funding, which is provided by Innovate UK, etc., is a fantastic source of funding, but it's match funding, and it will often need to be matched by other investment that's come in. A lot of the VCs who get involved, they want to be part of a co-investment process. For instance, DevBank Wales will often co-fund alongside angel investors and have their own angel group attached to that too. Angels are really important because they're that kind of core starting point. It's the really hard money. Once you get some great angels in your business investing money, then it's much easier to attract that really important, really effective institutional funding, and also to help unlock and attract grant funding as well. But it's not without its challenges. There are lots of individuals out there investing. Some sectors and some regions are stronger than others as well. A couple of things around the UK is we've seen one of the challenges is that it's very much centered around London and the Southeast. London and the Southeast attract about 60% of all angel investment into UK London-based businesses. At VC level, it's probably around 80%, maybe more sometimes, but on average, all equity, about 2/3 is going into London and Southeast-based businesses. So if you're based outside of that region, it can be a bit more of a challenge to attract capital, but it's not impossible. And we are working very hard with the government agencies of various to help build and grow access to capital across the board. In fact, DevBank Wales have done a phenomenal job in supporting the Welsh ecosystem. Also, another challenge is that kind of sector piece. So investors, the only way they're going to make a return on their investment is if their business that they invest in does incredibly well and exits for a huge amount of money and makes a lot of noise, which is all great, but only about 1 or 2 in 10 of those companies actually are successful. So investors will need to be really making sure they're investing in businesses that can grow fast, create a lot of value, and do that for as little investment as possible, which means as a result, digital technology companies tend to attract the kind of lion's share of investment interest. And by digital tech, it could be anything across, whether it's life sciences and whether it's in automotive indeed, but things which are more digital technology based is a lot easier, can be a lot easier to attract investment. Some challenges that we see is in attracting investment from angels in the automotive sector, because typically it's quite capital intensive and requires a lot more investment. It can be quite a long time before you start to get some investment traction as well, some commercial traction, sorry. And so it can be harder to kind of get to that next stage of funding and grow your business as you go. But angels are out there. We see some great automotive angels ranging from C-level executives from sort of big OEMs. We see them coming from having formed and grown and built and sold successful engineering firms. There are some really good angels out there that can be accessed, which is really exciting to see. And it's that kind of background of investor that will bring that additional value to you as a business. And this is why angel investing is crucial. They provide the cash at early stages, pre-revenue can be, but they want to see some level of traction or interest. They will also provide their expertise. 80% of investors, angel investors, are giving strategic advice to companies. They're helping to find new key hires. They're bringing their friends in to invest alongside. They're bringing in potential customers, because fundamentally, as an angel, and as most investors, equity investors are, they are fundamentally aligned to the success of your business. And so they are really crucial in helping to build, grow, and drive that business forward. So they're a really interesting potential source of funding. We recognize the challenges in the automotive sector, and it's why we partner with the APC, in fact, and do some really good work in both training through the TDAP program, so doing a lot of training for founders about how to access angel capital. But we also do and organize every year a pitching event too. So we bring our investors to come and see some fantastic businesses. So I do recommend that you check that out and make sure you stay on the mailing list for APC and keep your ears open for those kind of opportunities that are coming through. I hope that makes a bit more sense. Emma, I'll pass back to you.
No, that's perfect. And I think one of the points I'd like to draw out from that is that great advice you gave around the fact that there's automotive angel investors who are out there who are actually providing support and expertise and strategic advice for early stage companies. And that's why it's so important to really engage with the early stage investment community and the support ecosystem, because this is where you meet them. You know, if you don't engage with the Advanced Propulsion Center, you don't engage with some of the KTN activities, then you don't have that opportunity necessarily to meet these individuals. They can be difficult to find and build a relationship with. So that's a really good point that you brought forward. So thank you. Next up, we have Stephen Price, who's from the Clean Growth Fund. So Stephen is an investment director at the fund. He has over 11 years of experience in that early stage investing. And he's completed investments in lots of companies across multiple technology domains and in industry verticals. But I know that with the work that he's doing at the Clean Growth Fund, the focus is very much around commercialization expertise and market access for really rapid growing scale up portfolio companies with a net zero clean tech portfolio. So over to you, Stephen.
First of all, thanks KTN and APC for the invite to talk to you all this morning. Today, I'm just going to kind of give you a quick whistle-stop tour around the Clean Growth Fund, what we are, why we exist, what we try to do, and talk a bit about some of the areas that we're interested in from an investment perspective with regard to the transport sector, which is one of 5 kind of areas that we're particularly interested in. So the quick summary is that the fund is, so we like to call it a kind of unique, it's unique in the sense that it kind of combines government with UK founders and the investment community to support technology innovation to drive us to a kind of zero carbon economy. The fund is £60 million in size. Going back to the beginning, the kind of birth of the fund came out from the UK government, essentially, specifically the Department of Business, Energy and Industrial Strategy, who kind of recognized that there's an awful lot of grant funding that goes into some great innovations in the UK, much of which is funded by government through various schemes, of course. But a lot of those companies kind of take grant funding, do really quite well, but then kind of hit a wall, I guess, that kind of valley of death that we've already heard about this morning. And fundamentally, for some of the reasons we've heard about this morning, that lots of the mainstream venture capital money gets kind of funneled towards kind of digital businesses with lower capital intensity, perhaps shorter exit timelines. So what what we found, what the government found was that, and it's true that there's a kind of pretty much a market failure for venture capital to look at these clean tech innovations, which are super important, but notwithstanding that, find it very difficult to attract early stage venture capital money, in that post kind of grant funding scenario. So BAA's decided to create the Clean Growth Fund effectively, and a long story short, I guess, is that we were able to kind of win the mandate to manage that fund, and alongside the £20 million that the government committed to the fund, we've so far raised an additional 40 million from private sector investors, including CCLA and the Strathclyde Local Authority Pension Fund. So the fund size right now is 60 million, but we're still fundraising, and the target is to get to 100 million, and we'd love to do that by the end of the year. So the focus of the fund is very much at the early stage. I guess it's, you could think of it in terms of picking up where the angels kind of let off. So a lot of the investments we do sometimes have angels alongside us, but they might typically be into companies who've had a kind of angel round and are then looking for the next stage of finance. So we're typically investing in that seed to Series A kind of stage, writing checks of between £500,000 and £3 million. And very much, around half of the fund that we have is kind of earmarked for follow-on investments. So having the ability to continue to support businesses on their funding journey is super important to us, and it's obviously a key part of what we bring. The team at the fund's kind of unique, I think, and I'm going to talk a little bit more about some of the support that we can bring. But fundamentally, our teams have got 20 years of experience, specifically within the kind of climate and clean tech space, having worked with kind of scores of businesses over the last 20 years. So we've seen the kind of the original clean tech boom, maybe 15, 20 years ago. We kind of we got the scars from that, and we think we've got a lot of experience to bring alongside the cash that we can obviously provide. The fund is specifically focused on the UK, and we're looking to back the very best clean tech startups, clean tech entrepreneurs that we can find in the country, and we're UK wide. So frustratingly thus far, with one exception, most of the businesses we've invested in have been towards the south of the country, which for me, our office is in London, but I'm actually based near Newcastle. So we are actively looking for opportunities that are in the UK regions. So we're very aware of the kind of the London Southeast bias that we've heard about, and we want to try and deploy our funding, throughout the UK if we can. And a key part of what we do at the fund is, like any venture capital fund, we're obviously very interested in backing businesses that have the potential to grow very quickly and have a large kind of commercial outcome. But equally as important actually is the impact that the businesses could have. We're very focused on only investing in businesses that can have a significant CO2 impact. So we're looking for businesses who can legitimately claim that their innovations can have a very substantial impact on CO2 reduction or resource sustainability. And we ask all of our businesses to effectively make a forecast for how they see their impact evolving over time, and we have that self-assessment kind of independently assessed by a relevant sector expert, and that forms a key part of our kind of decision making on every investment that we make. So the thing I just want to pull out on this slide really is the key sectors that we're interested in. So transport, which I guess is the primary topic of today, is we're interested in transport, but we're also interested in power, industry, waste, and buildings. Now that's a pretty broad remit, and there's quite a lot of interconnectedness, we think, between those sectors as well, which I'll mention in a couple of slides. But Fundamentally, we're looking to invest, 500K to 3 million in these early stage businesses. We're happy to be the lead investor, but we're very, very happy to co-invest. In fact, every deal that we've done, and we hope every deal that we will do, we'll syndicate with other investors. We see that. We see investment very much as a team sport. So, co-investment is kind of in our DNA, really. So we love to work with other smart investors in the space, and hopefully try and bring other investors who perhaps aren't quite as comfortable with clean and climate tech. Maybe they're more generalist. So maybe give them some confidence to work alongside us with the kind of expertise that we can bring, to just try and generate more capital and more investment into this space. And I guess one thing that's kind of worth pointing out is, whilst we do invest, and we have, and I'm sure we will do more software businesses, we're very keen and quite focused to do more kind of hardware businesses. So the kind of, deep tech, science, engineering based businesses, which can often struggle to raise investment. Now, obviously, the capital intensity question does come up at that point. So, we can't, that there's a limit to what we can do in the hardware space, but hardware businesses are a key focus of the kind of deals that we want to do. This is a slide. It's a kind of, I guess, a different way of visualizing, the valley of death slide, I guess. But this is just showing where the CGF focuses. So we talk about investing where there's a kind of, we talk about having a commercial demonstrator. So that's not, it's not when you've got an innovation on the lab bench. It's not when you're just doing maybe a first small scale up. It's kind of when you've got something that's a commercial scale. It doesn't have to be the finished product, and you've got good engagement with the market. That you've got a kind of partner, or you've got sight of a first customer or a development partner. So that's the kind of point where we kind of get really interested. So we're not really funding fundamental technology risk, but we're very, very comfortable to fund scale up engineering risk, if that makes sense. So that's kind of where we sit. And as I said earlier, it's often where, businesses have been grant funded or angel funded, and then they're looking for the next injection of capital. A key part of what we offer is, in addition to the core team and the experience that we have there, we also have a very, very close relationship with a business called Carbon Limiting Technologies. So the Clean Growth Fund's managing partner is a lady called Beverly Gower-Jones, and she also has a kind of sister company called CLT. And CLT has, for many years been supporting clean tech businesses at the very early stages on kind of incubation and commercialization. And through our close relationship with CLT, we're able to bring that resource and all the people associated with CLT within their network. We bring that resource into the businesses that we invest in, where we can, provide support on specific challenges or issues that our investees have. And this kind of resource is I guess akin to a venture partner model that lots of venture capitalists have. But this resource is provided entirely free of charge to our companies. And I know for a fact that it's been super helpful already for many of our businesses. And I think it's one of the things that we can bring, which kind of differentiates us in a way, because the experience and the network within CLT is kind of unparalleled and second to none. And whilst we can't always claim that we have absolutely the right expert or experience to support each business, we're pretty sure that through the network we can find the right people that you might need, to address specific challenges. I suppose in just focusing in on the kind of transport sector, which, as I said, is one of our areas of interest. There's a list there, which I don't intend to read out, but there's a list there of the kind of spaces where we see innovation and where we're interested in potentially supporting innovation. But I think the key point on this slide really is that we don't really view transport in a silo. If you think about the electrification of mobility, clearly that has huge impacts on the grid and on power. So and on industry, in terms of innovation around manufacturing, making manufacturing more efficient and effective. So, as much as we're interested in some of those innovations in transport, the impact on power and industry is you can't untether the two. So, so we're interested in things like, flexibility and innovative energy networks and things that can support the ongoing kind of infrastructure requirements around the electrification of mobility. And just finally, I think just some quick thoughts really about if a company was thinking about approaching us, we would expect businesses to absolutely to maximize grant funding opportunities that are out there. It's fair to say that we're a huge supporter of Innovate UK, and especially their investor partnerships program, which we're a member of, and we've seen it be extremely effective. So for some of the business that we've invested in, great technologies are, we're looking to back great technologies, but having a great technology is not enough. There's obviously quite a lot. Great technology doesn't make a business. So, putting all the ingredients together around a technology to give us confidence that, a business can execute a plan and, make the kind of progress that we expect of our investees. It's really important, I suppose, to engage with the market early, particularly in transport sector, certain parts of the transport sector and supply chain, sales cycles can be extremely long, and engaging with market and having customer validation is super important. It's always something that we look for. And I guess specific to us, we expect companies to really do their homework on their impact, basically, so on their carbon return. So we want to see your great numbers, we want to see the forecasts be attractive, but for us, as I've said earlier, we zero in on the impact that you can have as well. So that's really important. So kind of do your homework on that if you want to speak to us. We always appreciate it when people are open about their weaknesses in the team, and we understand that at the early stages, businesses might not have all of the ingredients around the table, but being realistic about that and having a good plan in place to how you might address that is a good idea. And when you do come and try and raise money from us, and arguably any other investor, make sure you seek to raise enough money, and when we fund businesses, we funded them for at least 18 months. So, bear that in mind, when you come to us with an ask, think about, how much money do you need to fund the business for 18 months, and obviously where that will get you to. So, yeah, so that's all I wanted to say today. So sorry if I went on a bit long, but hopefully that's helpful.
Thanks, that's great. And actually, you've emphasised yet another point around the importance of sort of an accelerator incubator support in really driving success in those companies. And it can be as a source of deal flow, but also for the investee companies you're working with on how they can get that advice and engage in that community in order to accelerate their innovations. And I think that's a message that's really important to bring through is, you can't have too many friends in the industry. So next up, we have Lucy Rands, who's from the Environmental Technologies Fund. So this is a London-based VC firm that's been leading the way in sustainable investments for a number of years, in fact, since 2006. They have a really great investment thesis. It's sustainability through innovation. And what they're doing is identifying sort of and backing really high growth, high potential startups, which have a really positive impact. And this is around that social investment. Lucy joined the team in 2016, and she has a dual role, sourcing deal flow to invest in, but also supporting the existing portfolio on their business growth activities. So over to Lucy.
Thanks, Emma. I'm the final link in your value chain. So not always the last step before exit, but hopefully close and along the way, and coming in after the others in the group. I do have a couple of slides. I will just try and share those quickly. But Emma gave a very good introduction there. ETF, or the Environmental Technologies Fund, or ETF Partners as we go by, is a London-based firm. investing in high impact startups across Europe, actually. So we're not just the UK, but by our only offices here and by being based here, we end up doing about a third of all our investments in the UK. We also are aware of the North-South divide that I think Stephen talked a little bit about. One of our latest investments was in a Manchester-based business, and very keen really to do more in the north and in Scotland and Wales as well, where I think there's some really good deals coming through. So as Emma said, I've been part of the team for 5 years. The firm was founded a while before that, back in 2006, which is quite a long time for a climate fund. There's a lot of new money in the market now as well, which we see as a huge positive. Again, there's been lots of comments about working together and collaboration, and I think that's really key for the industry. So we're very glad to see more money coming in this direction. I think sustainability and climate as a topic as well can be quite broad. So we also talk about different areas and different focus areas. A key one of that is mobility. I think that also sits very close to energy, which we also look at. We have another topic that we call green networks, which is a lot around industrial tech, connectivity and IoT. And we do a bit in food and ag as well. And then more recently, we've got a new stream that we call the responsible consumer, or B2C businesses. And I think this is really interesting that we've brought this into the portfolio, just because the public is so engaged today in a way that they weren't even 5 years ago in the climate crisis, and the opportunities for investment there are really strong. So Emma mentioned our tagline, which is sustainability through innovation. And I think this really captures the core of our beliefs and motivation in doing what we do. And I think in general, we are incredibly optimistic about the role of technology and new companies in solving the climate crisis. I think it's very easy to get overwhelmed and anxious about the future of the planet. And I think that we strongly believe in new technologies and new companies in solving these problems. And I think that the topic of today is a lot around government and private investment and how they fit together. And I think that couldn't be represented more clearly than in the climate crisis, because we need both. We need lots of different types of government support. We need lots of different types of private investment to achieve that, and private capital to achieve that. And I think that the role of government and done well, which I think the UK government and the organisations that are here today and been mentioned today do a great job of leveraging what they do in private capital and having an impact well beyond their immediate reach. And that's something we then aim to do in turn by identifying, seeking out, investing in leading entrepreneurs and the operators who are trying to solve these problems. We do deliver impact well beyond our sort of 20-person team through the way we invest. Again, I think Stephen touched on this briefly, but I think what an important point to realize about most sustainability private funds is that we do need to deliver a return for our investors as well. So we're very much sitting at that point where profit and purpose align. I get asked this a lot: do you compromise anywhere on either of those? And no, we don't. We really want to back companies that can have an outsized impact and also that outsized return. And I think that this is a huge opportunity for private investment. And again, if things are set up right by the government and by the earlier investors along the way, that there's a huge opportunity, particularly in climate. And I think that the scale of investment we're seeing today is the tip of the iceberg of where we need to be and where we can be in the future. And I think Julian and others and Alex talked a lot about risk. And how we take that on as private investors, and that's something we obviously live and die off and have to think about a lot, is the risk and the timing of the investments we make. And so we coming in after where Stephen was talking about, we really want to see existing revenue in the businesses we're backing. We want to see technology that's working and that you found customers already to do that. And that's being translated into revenue growth. We also want to see strong teams, the differentiated technology, and all the sort of things that generalist investors want to see as well as we think about returns. And then we also want to think about the impact side. We do put a lot of time and effort into measuring our impact as well, and identifying and assessing that early on in the process and tracking it through the investment period as well. So again, that's a really important part of our thesis. But I think this point about risk, Alex talked about the valley of death, and getting to that point of growth round, we do rely on government. It might not be as direct as some of the other organizations here today, but certainly in the availability of good deals coming to our door, a lot of them along that way. In fact, all of them, if not all of them, will have received either government support or early angel investment to be able to get to the point where we would consider investing. So that ecosystem is incredibly important to us. And I think as well, we also have backing from the British Business Bank. So we do work more directly with government in that form. We made use of the Future Fund recently through COVID to support our businesses through the early phases of COVID. And we do attend Innovate UK, KTN conferences for deal sourcing. And I know, Emma, you're thinking a lot about diversity and ESG as well. And we do see the government as leading in this. And we signed up recently to the Investing in Women Code, which is a government-run initiative as well. So both on the sort of more concrete financial side and on the sort of initiative and networking side, we do see direct benefits from or collaboration with the government. I think this was commented on a number of times already, but I think the ecosystem as a whole is very collaborative. We like to co-invest. I get my best deals from other investors when the Clean Growth Fund phones me up and says, here's a good deal that's ready for your type of investment. And also other types of investors that aren't represented here today. So corporate venturing, project financing, and that side of things all has a part to play as well. And we all like to work together in building value in these companies. I did have an example, actually. I'll got a couple here, but I know we're a bit short on time, so I'll just talk about one. But Travel Time is a business that we backed a couple of years ago. It is a London-based software company doing mapping primarily with public transport. So it allows you to analyze journeys and distances based on time rather than distance. So it's very useful to a number of businesses in managing their transport. And where we really see that impact is encouraging people to use the public transport, unlocking the power that it can deliver. And for example, if you have a fleet of salespeople or plumbers or other service providers, they can use the Travel Time software to manage that fleet on public transport in cities instead of private vehicles, for example. Now, why I thought this was a good example for today is that Travel Time did receive grant funding from the government early on before we invested. They also received angel investment early on before we invested. And I believe we may have even met them at an Innovate UK conference. So it's a good example of how the ecosystem has worked together to create an opportunity that has attracted private investment going forward. Quick point on numbers and concrete things that we look for. So we do tend to invest in companies that have real revenue. Obviously not all revenue is created equally, so it tends to be £1 million plus, roughly. And we invest about £3 to £10 million or euros in any investment. We do then also support, alongside some of the earlier investors. Our support is slightly different. So we're more thinking about strategic movements going forwards, internationalization. So our network is very broad and international, and often at that growth phase that we come in, we can really support at that level, and also connections into clients, etc. So that's really how we think about our value add and taking the baton on from the earlier investors. So that sort of sums us up, really. I think in terms of advice for companies looking for funding, I think you will have to speak to a lot of investors. We see about 1,000 opportunities a year and we'll invest in about 5. So the bar is very high, and the selection very rigorous. But I think that because we're such a network and community, that what I would recommend is when you do speak to someone, if the answer is no or not yet, then ask, if not you, who, and if not now, when, or what would I need to show to you to get your interest, and how would I need to achieve that? And often investors are happy to be helpful to you along the way and support you to a point where they would be interested in investing. And I think most of you will know if you're already on this call, but there's so much support available in the early stages from government. And I think really taking the time to work that out and find out what it is and make the most of it, it is important. So pleasure to be here, and I will pass over back to you, MF.
Thanks. Another great presentation, and really highlighting one of the other key points, which is what sort of commercial and technical milestones you need to be at when you actually start speaking to high growth VCs, and actually having that conversation with them very early on to understand what it is that they're looking for, and building yourself up using all of those other investment support mechanisms, whether it's grants or that early stage investment community, to get yourself investment ready. That's a really important point. So if I can ask all of our speakers to put the cameras back on again, we'll now move on to a little bit of a panel discussion, if that's okay. Fantastic. So we had one question which has been answered, but I wonder if, Julian, you could just for the sake of people who may not have seen that, it's around that early stage grant funding to companies, and what sort of grants are available for early stage startups, which can sort of start de-risking that investment process.
Yeah, exactly. I mean, the sort of flavour of the question was, are effectively startups precluded from participating in grant programmes? And actually, you may know that since we left the European Union, there have been some changes to the way that the undertaking in difficulty tests have been performed. So actually, I'd just like to reinforce, being a startup per se does not preclude you from participating in grant programmes. But there are some other conditions that will necessarily apply, not least of which being that you must actually have a project that conforms with the terms of the competition that's being run. So if you are a startup and you've got technology that's effectively at fundamental research level, and you're applying into a fund, into a program that effectively starts at concept readiness, like the collaborative R&D programs at APC, so that's effectively TRL level 4 and above, then you probably won't get very far. You still need to comply with those conditions. But being a startup per se does not stop you. When you start to get later into the process, and you're looking perhaps particularly at capital grants to support later scale up, again, being a startup does not stop you participating. And we have supported startup companies with less than a year's full trading history on the basis of quite an extended due diligence assessment that has been performed, because we're dealing with, in some cases, some quite significant, grant quantums. But going through that process with adjustments around the risk profile and looking at mitigations for some of those risks, perhaps tying grant conditions into certain milestones in the project is a way to unlock the opportunity for startups with great ideas to participate in these programs.
Very comprehensive answer. Now, this is a question that I have for Lucy and Stephen. I noticed, Lucy, that you put one of the social development goals on one of your slides. And one of the things that we're seeing at the KTN is a lot more of the VC funds are actually having sort of ESG investments, and they're looking for SDG goals, and they're looking for quantification of carbon, reduction in carbon. For your two funds, how important are these criteria?
It's fundamentally important to what we do, to the extent that, we could see the most amazing, commercially nailed on return you could possibly imagine, but we couldn't, if it didn't have the right impact, the right level of impact, then we couldn't proceed with it. So it's completely baked into how we assess opportunities. We've devised a process, a standardized process, that every company needs to go through. So in addition to all the usual stuff, the forecast, everything you would normally expect to see, alongside that, we have effectively a carbon forecast, which is linked to how a business thinks that its business will develop over time. So we ask businesses to define their unit of innovation, and that's a catch-all phrase that can mean different things to different businesses. But basically, let's say it's a widget. If you're going to make this widget and somebody uses your widget instead of somebody else's widget, which is kind of maybe the status quo or the incumbent solution, then what is the carbon impact of transitioning to your new innovation? And then obviously, if you sell 100 of these this year, you just do the maths and it all scales up. And so we ask people to say, well, in 5 years and 10 years, assuming everything goes well, now we know it won't go like that, but there's assumptions around that. And so we can come to a quantification of the potential impact of every investment that we do. And that's a fundamental part of our investment committee decision making. And whilst that assessment is driven by what a company believes and what it assumes about its scale up and its technology, we have that independently assessed often by an academic expert who has knowledge of the field, who basically kicks the tires on the assumptions that the company have used around their impact. And again, if the independent expert doesn't concur with what the company believes, then it's not something we can move forward with. So that takes away our potential bias, and we really want to do a deal, but this assessment by a completely independent person says the impact case just doesn't stack up. So that's how we try and ensure that we only invest in the right things. And then on an ongoing basis, obviously we monitor annually. We ask companies to report back on their impact, and we kind of obviously monitor that against where we thought we were, and obviously we can potentially make interventions to improve the situation. But that's it's fundamental to what we do.
And Lucy, how does it work with your fund?
Yeah, so similar answer in that it's absolutely fundamental to the investment process. And I think one key distinction to make, which Alex knows that I like to make, is that I think it's important to distinguish between ESG and impact. I think both are important and both link. But I think on the impact side, it's very much around the core technology and the potential of the core technology. And I think of ESG as the responsible running of a business, both of which we want to see. It's kind of easier to change the second one, the ESG angle, than it is to change the core impact of a technology at the point you invest. And I think a lot of the measurement metrics and frameworks that are used for public companies tend to fit ESG. And they're around things like, does your business recycle? How often are you getting on a plane, et cetera, et cetera. And that is almost meaningless in a small company, in a small growing company, when the real impact that you can have is through what can that core technology achieve in the long term? How much waste can it save? How much emissions can it reduce? So I think the way that we track and measure has to take that into mind. And similar to Stephen, we also pick a KPI for each company along with the companies, so that we're able to track how they perform on an impact side going forward. And we also developed our own system that does take into account some of these frameworks that exist, but also some of our own ones, and make that work for the startup. And really thinking about the future and the potential of if you roll this out at scale, where's it going to get to, and what can it achieve? I think just quickly on the ESG side, I also think this is super important for startups, because it's easier to build a responsible business than it is to try and make those changes later. So it's also something we think about a lot, and diversity and governance and all these things, and really trying to support and encourage the companies to grow in a responsible way, as well as having as much impact as possible.
That's actually a good point, which I just want to hold you on for a little bit. I read a Deloitte study from 2020 that showed that only 13% of the workforce in the automotive sector was female. And I'm really interested in what role investment can play in actually addressing this underrepresentation. Do you have any advice as well for females in the area? And I'm going to ask actually all of you around that, because I know, Rod, you've been doing a lot as well. And it's but I'll start with you, Lucy.
Yeah, I think 30%, Emma, is better than some of the other tech industries.
30, 1-3, not 30.
Oh, 1-3, okay.
Yeah.
Okay, yeah.
It's fairly appalling.
Yeah, I mean, it's a huge challenge, and I think there's a real desire in the industry to address it today in investment is my feeling, and there's a lot of initiatives around to encourage more women into investment, and actually the other reason that investors want diversity is because there's data to show that diverse teams perform better. So actually, we all really should be driven to make changes in this area. There's some fantastic research done by Diversity VC, along with the British Business Bank, I think, on all these things. I'd urge people to read it. They also brought out a toolkit for investors with just some advice on how to improve these things. What we've done is started with our team, actually. So we focused when I joined ETF 5 years ago. I was the only woman on the investment team, and today we're almost 50-50. So we've really focused on increasing the diversity in our team first. We also signed up to the Investing in Women Code and are looking to the government for support in this area as well, and thinking a lot about what we can do going forward to back more female founders. But it's definitely a challenge that needs addressing, and there's desire to address it.
Thanks. And Rod, I know you've been doing a lot through UKBAA. Would you like to just sort of
Yeah, I mean, I think it's one of the things, there aren't enough female founders coming through. I mean, we're seeing the amount of investment they're receiving is significantly less than the male counterparts. So it's a big challenge. And I think from a trade body perspective, one of the things that we want to do and focus on is changing the investment community. It's one thing, if you've got some fantastic female founders trying to raise money, they're constantly raising money from a wall of men, and it's just not right. So we've been working really hard in helping to grow and increase the number of women who are investing at early stages. In fact, angel investors are probably about 15, maybe 16% women as well. So it's still a big challenge on that investment side. So we want to change the face of investment by in doing so, we can help support more female founders and great women who are coming through. We've seen the stats. I mean, Lucy's mentioned that more diverse businesses are actually more successful. There's some great Kaufman research that shows that as well. But also what shows is women investors are more likely to invest in women founders. And so by increasing the investor side and improving it, then hopefully we can get more capital and more channel towards female founders. So we've been founder signatories on the Investing in Women Code, for instance, and we're very much starting the data collection around that to understand some of the key challenges that we see across the industry. And that's been a really important part of our work, and will continue to be so for many years to come, I suspect.
Thanks. Alex, regionally, what's Wales and the Development Bank of Wales, as the Welsh Government doing around that?
Punching above its weight, I think, is the answer. So we've actually got quite a strong percentage of female founders in our portfolio, or at least female-led teams. And, it's rough, speak under correction, but roughly 15%. Whereas the industry average is very early single digits. And I mean, I think I would love to know the stats as to what percentage of female founders apply and get rejected versus male founders, whether that is where the real issues lie, because hopefully people are don't have biases and are investing objectively. So I think that's something to look at. And and personally, I prefer investing in female founders because I find they're more balanced, they're more emotionally mature, they work better with suppliers, customers, investors. I'd like to see it happen, and I'm glad that we're leading that change.
Going to sort of change a little bit the tone of this, but still carry on the theme, if that's okay. And I'll bring Julian in and then Stephen. But one of the things I've seen is that the way you design programs and the support programs like the APC sort of early stage sort of programs, and having things like the the CLT offer that can really support and sort of nurture and grow people as individuals and their confidence as well. How important do you think is program design? I'll start with the APC around making it accessible for female founders and for more diverse, not only just female, but more diverse community. I mean, do you think that there's a role to be played with that incubator accelerator program?
I think there is. And actually, it's really around just having a complete philosophy around meritocracy as a principle. That gender is no determinant of great ideas or great conviction. And if you start with that founding principle, actually, you design your programs to be, completely meritocratic. Just look for excellence where it exists, and it comes from across the whole spectrum. At the APC, more than 50% of our executive is female. 2/3 of my own first line is female, for example, and when we've got a full spectrum of diverse backgrounds as well, from engineering and technical and non-technical backgrounds. And that adds a richness and a context of background and colour that really helps us design programs that recognise excellence from wherever it arises.
Yeah, so Stephen, I know that obviously you work very closely with CLT. I mean, do you find that them having those kind of programs accessible to your investee companies and working with them really helps support a more diverse sort of founder and workforce?
Well, having CLT certainly is extremely valuable, and all of our investees do value it greatly. I don't, honestly, I don't, we just want to support the best, diversity is super important, and I agree with everything everybody said. We were signed up to investing in Women Code and all that, but I don't. The CLT support doesn't have any specific targets or objective to change the balance. But where we engage with CLT, they're supporting the companies that we've already invested in. So I guess we're a step back from that. So we're hoping to invest in more female founders and invest in teams that are more representative of society. Because I think as Lucy said, there's a lot of data which suggests that that success correlates with diversity. We've got some way to go. It's a difficult problem. If we come back to female founders, we want to invest in the best opportunities we see, and we hope to see more of those to be female led, or have more female representation on the management teams. And I don't know, I haven't got all the answers, but where the issue is, maybe there's something in this sector to do with kind of underrepresentation of females in kind of STEM subjects at university, which maybe we can look back at that. But I think it's also trying to inspire more females, I think, to have more role models. That's an issue. Absolutely, to try and, I'm a kind of white middle-aged man, that weighs heavy on my shoulders. In the team, we need to have our own team to better reflect. It's fantastic what ETF have done over the last 5 years. That's an amazing result, and we need to get to that too internally. We're fortunate to be led by a very influential lady at the helm of our fund, and we've got great plans to try and increase that. But yeah, it's a difficult one, isn't it? But I think we're absolutely on board, and we want to do everything we can to ensure that we build a portfolio that's as representative as it can possibly be of kind of society that we see around us.
Thank you. Alex, I saw you had your hand up. Would you like to contribute?
It might be slightly controversial. I'll try not to make it controversial. But I think, like when you get to the point of investment, that's, a lot has happened before that in your career, in the investor's career. That's the end point. Let's start early. And I think for me, it starts at home, in terms of, the percentage of ladies that study STEM subjects. When I did engineering back in 2004, there was 400 men and four or five ladies. And then we wonder why the automotive sector doesn't have a lot of, they just didn't study the right degree to get into that sector. And in South Africa, it's more linear. If you study engineering, you do engineering, as opposed to the UK, where you can do something different. But I still think it does start at home, because in our team, one of our colleagues has gone on paternity leave for 9 months. And he thought he could do that and also look after his investee companies. And it's quite funny. I have a few calls with him when he's feeding the baby and like, patting it and everything. And it's impossible. And, the reason he's done that is because his partner runs a very, very lucrative entrepreneurial business. So it just made economic sense for him to go on paternity leave. And how many men are actually doing that? And, looking at the overall responsibilities of a family, allowing their partners, male or female, to pursue careers such as startups and venture capital, both which are very demanding and don't work with the 9-to-5 schedule.
There's some very good points that you've all brought forward. Certainly my observation has been that, sort of having sort of incubator accelerator programs, which are open to everyone, but are structured in a certain way that sort of they address the different challenges that people meet from different diverse communities, and it's building up their networks and the communities that they can have that peer-to-peer learning is really, really important. And I think one of the things that we can all have a role in is actually supporting that peer-to-peer network in diversity and inclusivity in general, to sort of build up people's skills, capabilities and confidence to go out there and demystify some of the things that are going on. If people see the statistics, then they say, well, is it worth me trying? And I think as we can start shifting the statistics like ETF's done, just within the fund, straight away, my confidence maybe approaching ETF is very different, because then, well, it's got really good gender representation. I've seen, the Development Bank of Wales is the same, it had some very positive impacts. And actually maybe shouting out a little bit more about your successes in those areas and promoting them will also give people more encouragement to be able to do that. I think storytelling is really important. And I suppose that's a call out for all of you. How can we get that message out to our communities? I'd like to shift just for the last bit before we close to a little bit about the supply chain and the challenge that companies in this sector have of reaching their customers. They're usually quite complex and very tortuous supply chains. Is there any advice around how you can de-risk your technology, your investment opportunity, engage with the supply chain? And I'll ask all of you actually to have a sort of chat about that. I don't know who'd like to go first.
Perhaps I'll take that one in the first instance, because we've been doing quite a bit of work at the APC to develop the extended supply chains, particularly in the electrification space. And we're actually dealing with an environment where the raw materials and intermediates are changing many of the drivers for localization. When we're looking perhaps at investments around manufacturing a few years ago, the arbitrage was really around operating cost structure, primarily driven by labour. Actually, I think what we've seen over the last 12 months, 18 months in particular, is that actually the resilience of supply chains and being able to secure your upstream materials, and I'm going to take semiconductors as a case in point, and having transparency and visibility of every step in the upstream supply chain is absolutely vital. So I think lesson number one for me is make sure that you've got really good visibility of every step in the upstream supply chain. And lesson number two is try and secure longer term supply agreements to ensure security of supply when you can see that there is likely to be a pressure on some of those upstream materials as the markets start to evolve. We know, as an example, for battery materials, there are certain materials that are likely to be in short supply. So the winners of tomorrow will be those that have secured, offtake agreements, guaranteed supply routes in the future, and not necessarily those that are the lowest cost producer today. So the nature of the game is changing as the industries start to evolve. But transparency and longer term supply agreements, I think, are the two key points of advice I would give upstream.
Any advice from the others?
I'll focus on the finance piece. I think it's making sure that you've raised enough finance so that you move from that just-in-time model to more towards the just-in-case, have some redundancy built into the system, some stock on hand, and also linked to that, make sure you treat your suppliers well. So a lot of, specifically startups will say, oh, cash is running tight. They'll try and stretch those creditor terms and really upset their suppliers, and then they go with someone else who pays quicker. So look after your suppliers and they'll look after you.
We could also talk about sustainability in the supply chain, and we've actually backed a couple of companies, Julian, just in the area you're talking about in supply chain visibility and understanding sustainability of it. So I think it's super important. I think, Emma, you also touched on kind of going to the customer and communicating to the customer. And I think in the early stages of a business where you can partner, it is great because you add credible names to your organization and your pitch deck, and you also achieve scale through default through your partner scale. So I think on the flip side, on actually going out to customers where you can partner with big organizations is useful.
Stephen, you've talked about having really good connections and links for your investee companies into the wider ecosystem. I mean, how for an early stage company, when and how should they start building those relationships? Because they might not be ready, but they need to know who they are. What sort of advice would you give?
Well, you can't do it too soon, I would say. You know, and thinking about this question, I'm thinking about an actual company we're talking to right now, and thinking about what they've done really well. And it's you know, where you've got kind of complex supply chains with potentially long sales cycles or lead times, or it's really, really important to make sure that your particular innovation is critically addressing, you know, a real urgent problem. You know, it can't be a kind of nice to have. You know, that doesn't make for a compelling conversation with a potential customer. So it's about understanding where your solution fits within that supply chain, who owns that problem, you know, who lies awake at night thinking about, you know, they need to develop a solution for this, you know, and you know what's on fire for them, you know, and making sure that your solution, and then make sure the conversations that you're having within there, you're speaking to the right people who can make decisions. You know, what we see a lot of is a lot of, you know, innovative young companies talking to people who they think they are their customer, the decision maker, but they're actually people whose job it is to kind of tinker, to explore, to look at various things, not the people who really, really care about the problem that you're looking to address. So it's about speaking to the right people, and it's complicated. You know, investment cycles on the customer side could have a big impact. You know, depending on the nature of your innovation. But if your clients just invested, you know, a significant sum of money in an alternative, or you know, they're invested in that, it's going to be really difficult to move the needle for them, get them to adopt your particular innovation. So it's just about there's really a lot to be said about that customer discovery and customer validation piece, which you've got to do up front, you know, before you've devoted, you know, too much of your own time developing a solution. You know, you can't underestimate how important it is to really get out and speak to customers, and you've got to do that, you know, as soon as possible.
And Rod, I mean, one of the things you brought up, this is sort of like the last closing bit, is how many of your angel investors are actually senior people from within these organizations. So what advice would you give to our companies around using the angel network to find those sort of influencers who can answer some of those questions that Stephen's raised and make those introductions? Yeah,
it's a good question, Emma. I think one of the things I'd actually recommend is to use your own network for a start. I mean, there's a lot that you can do, you know, as you're in the automotive sector, the engineering sector, wherever it is that you are, but you would have hopefully built up a bit of a network around you as you've gone through your career. Also, don't underestimate the benefits of LinkedIn and forking out 40 quid a month for LinkedIn Premium just to help reach out to these interesting C-level execs. And don't ask necessarily for money, ask for advice. Ask for advice, you get money. Ask for money, you get advice. So think about how you can utilize building out an advisory board to actually engage really helpful people. And that can help get you that crucial customer validation that Stephen mentioned, which I think is really important as well, by the way. So building out, kind of getting that board of supporters of people who have really great industry expertise behind you. And the next stage of evolution with your relationship with them is that hopefully they'll make an investment. And then you've known yourself a nice lead investor with industry experience that you can use to excite and engage angel networks, angel groups, maybe some of the early stage VC funds as well, which can be really supportive there. So that's kind of my my advice is to start off with your own network where you already have some relationships and work those channels first, for sure.
Thanks for that. It's a really great way to sort of close it up. As I said, you can never have enough friends. So first of all, before I go to the last closing slides, I'd like to thank each of our panelists, Alex, Stephen, Lucy, Rod, and Julian, for really great sort of insight and discussion around the opportunities around investment. And it's not just around automotive supply chain and the automotive sector, but actually around your whole business approach and your investment strategy. Some really, really great insights. So I'm going to use the traditional way if I can. I don't know if I can do that. No, I don't have the option to give you a clap on my screen. Sadly, I can only raise my hand. So this is a challenge, a call out for all of you really, is, what's going to happen after COP26? We've got a lot of pledges that are being made, a lot of really great ideas and innovations that are going in there. But, what is it that we can all do to actually have an impact on that? As sort of entrepreneurs, as investors, and all of us in the support sort of sector as well. We've got a really great opportunity to sort of keep these conversations going, sort of promote collaborations and actually start accelerating these innovations. So there are a number of ongoing activities post COP26. So I'm just going to promote the KTNs. We have post COP26, we're going to have 4 events. There's one focused on decarbonisation, one on circular economy, one on resilient places, and one on enabling action. So we'd really love you to join us. You can sign up for those on the KTN website. But before we get to that, we have the next event, which is being run by the Advanced Propulsion Centre, which is on the 19th of October and between 10:30 and 12. And it's the title of this one is going to be How Are We Powering the Way to Net Zero Emissions? So it's focused on alternative fuels, hydrogen and electricity. At that point, I'm going to say thank you so much to all of our panelists. Thank you for the APC for inviting the KTN to host this session. And thank you for all of you in the audience for your Q&As and for your participation. So thank you very much.